Hello students, today I will be discussing another small unit of management accounting, that is analysis of financial statements. So as you all know, the financial statements are the essential documents of the business, which includes income statement, which is also called as profit and loss account, and position statement, which is known as balance sheet. So what are the objectives of these financial statements? The first and the foremost objective is that it provides information about assets and liabilities of the firm. It provides useful information to various parties interested in knowing about the financial statements, to present a true and fair view of the business, and also to estimate the earning capacity of the concern and to decide about the future prospects of the business. So moving on to the importance of financial statements. The financial statements are of much importance to the management and also for the outsiders, namely the investors, creditors, banks, customers, employees, government and the other agencies, public and also the trade unions. Now we'll move on to the meaning of financial statement analysis. So financial statement analysis, it is a process of evaluating the relationship between the component parts of a financial statement in order to obtain a better understanding of a firm's position and performance. Now we'll move on to the types of financial statement. So on the basis of the mode of operating, we have horizontal analysis and vertical analysis. So what do you mean by horizontal analysis? It is the analysis done for a number of years. That is, the figures of various years are compared with the base year. A good example for this horizontal analysis will be trend percentage and comparative financial statements, which we are going to discuss when I solve the problems. The second type is vertical analysis. It is the analysis made for the data covering 1 year's period. Example, you have ratios and common size financial statements. These two are the examples for vertical analysis. And second classification, it is made on the basis of materials used. We have external analysis and internal analysis. External analysis is an analysis made by the outsiders who have no access to the books of accounts. That is, who don't have any access over the books of accounts. That is, shareholders, creditors, government agencies, etc. And the internal analysis is the analysis made by the internal parties. That is, who are these internal parties? Who have access over the books of accounts, such as management and the employees. So now I will be discussing about the types of analysis and interpretation of financial statements. The first one you have is comparative financial statement analysis, common size statement analysis, trend analysis, ratio analysis, fund flow analysis and cash flow analysis. So in this unit we are going to study comparative financial statement analysis, common size and trend analysis. Under comparative financial statement analysis, we have two types of analysis, that is comparative balance sheet analysis and comparative income statement analysis. And similarly, under common size statement analysis, we have common size balance sheet analysis and common size income statement analysis. So let us study what do you mean by comparative financial statement analysis. Under this method, the financial statements of different period, note down students, it is the analysis of the financial statements of the different period of the same concern in order to derive the significant change in the financial and profitable position of the concern. So comparative income statement analysis can be done. Okay, it may be either comparative income statement or comparative balance sheet analysis. So comparative income statement analysis is prepared to know the net profit or loss for a number of years in a comparative form, and comparative balance sheet analysis is prepared to show the position of the company for a number of years in a comparative form. So the next one you have is common size statement. It is a type of statement in which each item of the financial statement is expressed as a percentage of the appropriate total. That is, the appropriate total is taken as 100% and each item is shown as proportion of this 100%, which I am going to discuss while working out the problems. So again, under common size statement, we have common size balance sheet and common size income statement. Then the next one you have is trend percentages. So the trend percentage is a technique of studying financial statements of a company over a number of years. Under this method, a representative year is selected as the base year and the values of each items in the base year are assumed to be 100. then the relationship of each item in the subsequent years is expressed as a percentage of the same item in the base year.